Hello, welcome to the Orator Academy once again. Imagine you have opened a shoe manufacturing company with 1 crore rupees, and would you spend all the money on a machinery, or you would spend or save certain amount of 1 crore for paying your day-to-day operations activities like buying the raw materials or paying the salary checks or paying the electricity bills? What would you do? This single decision introduced us to fixed capital and the working capital. Welcome back, student. Today we are having a very important topic and very important discussion on a certain questions that I have just reiterated. What do you mean by fixed capital? Or what is a machine? Why is machinery a fixed capital? How do you recognize this as a fixed capital, or why do you recognize this as a fixed capital? So fixed capital refers to the investment in the long-term assets that remain or continue to exist or stay invested in the business for more than a 1 year. Management of fixed capital involve long-term resource allocation that impact growth or say expansion, profitability, risk complexions over time. So when you are understanding the concept of fixed capital, so it relate long-term assets is used to continue or to be used in a business for a long period of time for manufacturing goods and services, and that will help you to expand your business, to reiterate your re-engage your growth, increase the profitability and risk complexions when you need over time. So this is how you use your fixed capital to buy more and more fixed assets. So fixed capital is what? Fixed capital is a machinery used for a long-term business or manufacturing goods and services. So you can highlight that machinery is a fixed capital, or you can understand or you can remember that for examination point of view, machine is a long-term asset that you use in your business for producing or manufacturing different goods and services, the kind of business you are doing. But as we have started our discussion today, we have a shoe manufacturing company, so we have a machinery to manufacture shoes and provide the services. So this is how machinery is a fixed assets and used for a long-term assets in our business. But how do you start? How do you initiate? Why you have a fixed capital requirement? Or what are the factors that will affect your fixed capital requirement? So which factor change the most in a modern business? Which factors changes the most in a modern business? Why do you need only fixed capital requirement, or do you need short-term business requirements? What are your requirements? You need to adjust it. You need to identify your requirement based on your business. So my question is, which factors changes the most in a modern business? So when we are discussing about fixed capital requirement, we need to focus some of the factors that will help you about your fixed capital that you need to maintain or continue to invest it in your business for a long period of time, because fixed capital is continue to invest it. Your fixed capital remain with your business for a long period of time, and you need to invest in your fixed capital that will continue with your business for a long period of time. But you need to understand certain factor that will manage your fixed capital requirement viable. First, what is the nature of your business? Manufacturing concern require much more fixed capital than the trading firm. If you are, say, working as a shoe manufacturing company, definitely you need a very huge amount of capital for your machinery, for your business, for your premise, for your furniture, and for your day-to-day, for your long-term business perspective. So in this case, you need to understand the nature of your business that will affect your fixed capital requirement. Second, what is the scale of operations? What is the scale of your operations? Are you operating at a large scale or are you operating at a lower scale? So, for example, shoe manufacturing companies are working as a large scale operation that dictates bigger plant capacity and special needs or requirements. Because when you manufacture a particular shoe, then you need a big space, big plant, so that you can manufacture different size of shoes, different with a different kind of material, or you need a very good space when you increase your large scale operation or when you maintain your large scale operation. So in this case, you are working in this particular section or you need to manage your fixed capital requirement. You to invest a huge amount of money as a fixed capital. So it will help you to manage your business. It will help you to increase the size of your business, or you can buy more area to manufacture more and more shoes with the more and more raw material. Next, choice of techniques. Capital intensive organization require higher machinery investment or capital investment. If you organize issue manufacturing companies that is totally based on the techniques, you definitely need a very large amount of money in your business because the machinery you purchase, the way you are working, the way you producing your shoes will definitely will be totally technology based and your machine will be technology based. It will automatically cut the raw material, mold the size, mold the material, and will design a particular shoes. So in this way your choice of techniques will matter most in this case. Next, technology upgradation. Faster assets obsolescence increase frequent assets replacement needs. For example, if you are using a technology-based machinery and it needs a technology upgradation every 2 years, in every 3 years, then you need a very huge amount of capital in your business because after 2 years, your machinery would be replaced, your technology would be upgraded. So your faster assets obsolescence increase frequent assets replacement needs. You need to upgrade your machinery. You need to sell out your old machinery and you need to buy a new one. So this way you need a higher amount of capital in your business. So you need to be very careful about the same. Next, growth prospects. Expected expansion choice require proactive higher capacity creations. If you're if you are shoe manufacturing companies and your plan is to expansion your business for a in a different cities in a different countries, then you definitely need a very good amount of capital in terms of money, in terms of business requirements. So when you are expected to expand your business, expanded your area of operations, you want to open new branches, new premises, new outlet, everywhere you need a huge amount of capital. So in this way, you can increase your capacity, you can hire your capacity or increase your capacity that will escalate your business expansion. So in this way, you are really affected by the fixed capital requirement. Next, diversification. Entering a new product lines significantly expand fixed assets requirement. If you want to diversify your business, if you want to come into other sectors, whether it is apart from your shoe manufacturing, then you definitely need new product line and definitely new product line require you or demand your further capital to be invested in the business or remain in the business for a new machinery. So you should be very careful about if your diversification require huge amount of money for your business. So when you are entering a new product line, new services, significantly expand fixed capital requirement, fixed assets requirement. You will require a new machinery, you will require a new premise, new office, you will require new furniture, you will require new variation in your fixed capital requirement, new research and development. So everywhere you will require a huge amount of capital in terms of fixed amount or fixed capital. Next, it's a financing alternative. Availability of leasing choices reduce or lower outright sales assets purchase burden. If you have a business of shoe manufacturing company that definitely require a huge amount of capital over a period of time, or sometime you continue to have a requirement of fixed capital, then if you have an option in the market that you can lease out or you can take some of the property on lease, you definitely will not buy a new machinery because you have a leasing amount option, you have a leasing choices in which you can buy the or you can purchase or you can hire the machinery on a rent. You can hire the machinery on a rent, then you do not need to buy a new machinery at all. So if financing alternative allow you to take the machinery on a rent, then you definitely will not purchase or buy your assets that will help you to produce more and more goods and services because it will be a cheaper option for you. You will save your money, you will save your capital, you will save your amount for other option. So definitely you will go for licensing choice or a leasing choices. So leasing choices will allow you to take the machinery on a rent rather than buying them. Okay, so this is the financing alternative. And next and last factor that affect our fixed capital requirement is the level of collaborations. Shared common facilities reduce individual corporate infrastructure requirement. Shared common facilities reduce individual corporate infrastructure requirement. Suppose you have a two different diversified business under one unit, under a one company. But the same business require you to use the common facilities for your business. Your machinery would be same, your employees would be same, then you can use the level of collaborations. You can use same kind of machinery for producing different type of goods for a different product divisions, right? Sometimes common facilities will help you to do the same, and then it will lower the individual corporate infrastructure requirement. You do not need to buy for the infrastructure for your business. You do not need to buy a new machinery for the, other business. You can use in a shared manner whatever you have in terms of your infrastructure. So you can allow your business to have a collaboration. This will reduce your fixed capital requirement, or this will affect your fixed capital requirement. So in this way, you can identify what are the main factors that affect your choice of fixed capital requirements, right? So this is how you use your fixed capital requirement and how you understand your fixed factors that affect your fixed capital requirement. But the story does not end here. We have studied only one part of the business requirement. Other part is yet to come. That is in a form of working capital. After studying the fixed capital requirement, we are moving a very important topic that will help your business to sustain in the short term requirement or in short term visions. But before this, there is a one fundamental question that also affect your working capital as it affected your fixed requirement or fixed capital requirement. Why can't a profitable company survive without a working capital? You have invested a significant amount of money in form of fixed capital. You have purchased a machinery, you have purchased a furniture, you have purchased a premises. But why do you need a working capital now to remain profitable in a short term? Or why cannot a firm survive without a working capital? So this is how we use or how this concept will help you to understand the new topic in a different perspective. You definitely use your fixed capital for purchasing a machinery, furniture, premises, and the process, technologies, technical upgradations, many more things. But working capital refers to the investment in current assets that facilitate or streamline efficient operation or smooth day-to-day operation or get converted or transformed into a cash within a 1 year. Because working capital refers to the investment in the current asset. You want to buy the stock, you want to sell your product in cash or in credit sales. So this will facilitate, this will streamline your day-to-day operation that will be cost effective, smooth, or transform or converted your investment into cash within a 1 year. So this is the definition of working capital. Working capital is required for a day-to-day working. Working capital it very much is concerned with the day-to-day operation. It will help you to just you have a requirement of a stock, you have a requirement of some important business material, you have a requirement of paying the salary to your staff, you have a requirement of paying the electricity bill for the factories. So this will help you to continue or streamline your business on a day-to-day basis so that you can convert the investment of working capital into the cash as soon as possible. You do not have to wait that I have invested this amount of money in manufacturing of shoes and something else. Now, how will I share or how will I sell my shoes to the in the market and how will I get my money back in how much time? You do not have to wait. In a 1 year, this would be transformed or converted into a cash. So this is why you need to invest in a working capital requirements. That's why you need a working capital. So when you are dealing with a working capital, you have to understand about the current assets and the current liabilities. So this is a concept related here. It's a net working capital. Net working capital refers to the difference between the current assets and the current liabilities. It requires striking an optimum balance between the liquidity and the profitability. The net working capital required that how much money I need to buy a particular stock, how much money I need to buy a particular raw material, how much money I need to pay my uh, staff, how much money I need to pay for my electricity or insurance bills. But simultaneously, it will focus on the other part as well, current liabilities. You are buying a raw material, you are buying supplies from the market. Sometimes you are buying in a cash, sometimes you are buying in a credit as well. So this is the difference between the current assets and the current liabilities that you maintain in your business, and this is referred as net working capital. So excess of current assets over current liabilities, over current assets that your items or related with the debtors, related with your stock will be converted into a cash, or current liabilities that you have to pay to outsider in terms of creditor, in terms of BP. So once you have a higher side of current assets over your current liabilities, definitely you have a positive working capital in your business. You are having a more money in terms of working capital when you have a current assets and higher than your current liabilities. So this is how your working capital will definitely require for a business to survive, even though you have a fixed capital invested in your business. So one company cannot survive, one company cannot be profitable alone if it is only investing in fixed capital. It need to invest in working capital as well. It need to understand the requirement of working capital as well. So there might be a crucial difference. There might be important difference between the working capital and your fixed capital. But before contrasting, before understanding what is the difference between your fixed capital and working capital, we need to understand what are the factors that affect the working capital requirement at the as a factor affect the fixed capital requirement. So, what are the factors that affect the fixed working capital requirement? First, it is a nature of business. But factor affecting working capital requirement have has also its own a very important question. That is, how does liberal credit policy affect the working capital? During a business, we design a different policy related with the credit. Credit is sometimes we receive, credit sometimes we give to our customer. Credit we sometimes take from our supplier. So if you are having a liberal types of credit policies, then definitely it affect your working capital. But factors will help you to judge that what kind of liberal credit policy you must have in your business. So first factors will have nature of business. Processing needs mean manufacturing entities require a larger operation cash. Processing needs mean manufacturing entities require large operation cash. If you are have a business that required a continuous process, continuous manufacturing, then definitely you need to have a high operational cost. Suppose you are manufacturing a shoes, continuously you are buying your leather, your resins, your accessories. So it will be continuous in a process. So this continuation in the process will allow you to have a more working capital in your business. You need to maintain a high amount of cash in your business. So this is how you understand the nature of business that definitely affect your working capital requirements. You cannot ignore it. So this will help you to understand nature of business. Second, scale of operation. Higher operational scales dictate substantial inventory or debt holding. If you're handling the scale of operation in which you have to maintain higher inventory in terms of finished goods of shoes or finished product of shoes, or you are selling on a credit basis, then you are definitely piling up of your stock. You are definitely engaging your money in your business. You are not able to recover that amount as soon as possible. So higher operational scales dictate substantial inventory and debtor holdings. So in this case, you need to continuously acquire some extra working capital for your smooth function of your business and smooth flow of your business. It will help you to facilitate efficient day-to-day operation. So that's why you need to maintain working capital requirements. Next, business cycle. Business cycle is a very important concept here. Economic booms drive sales higher, expanding working capital needs. If you are going through a phase in which the economy is booming, economy is growing fast, your product that you have manufactured, it is being sold as soon as possible or in a very fast pace, then you do not have to worry because the money will come to your business Once you start manufacturing or end with the selling of the goods, your money will rotate, your business cycle will rotate fast, and your invested amount of money will come to you as early as possible when you are talking about your working capital requirements. So your business cycle will definitely help you to maintain whether you need a working capital, whether you need a higher working capital or whether you need a low working capital. So business cycle will definitely impact. So if economy is booming, then your definitely work business cycle will be lower. Your working capital will be come to you easily in a very easiest manner as soon as possible. But if business cycle is following sluggish or less money or less economic activity, then you have to wait for your sales, wait for your profitabilities. So in this case, your working capital requirement will be higher and you need to invest more and more working capital in your business, right? So this is where you are working in this particular scenario. Seasonal factor next is important one. Peak activity seasons demand substantial operations fund arrangement. Seasonal factor. Suppose you are having a seasonal demand. Your shoes will be marketed, your shoes will be sold during the season, say Christmas, Diwali, Dashera, on any on any other business or a seasonal cycle or seasonal factor, then during the peak activity season, you need to maintain a higher working capital requirements for your business. It will call for substantial operation fund requirement. So during the peak activities seasons, it will call for substantial huge amount of fund that you need to maintain in your business for your working capital requirements. Next, production cycle. Longer time span converting raw material to a product elevate cash needs. Longer term span converting raw material to a product elevate the cash needs. It depends on your production cycle. The higher the time span that your raw material will be converted into a product, then you definitely no need of a cash at all, because it will take time in manufacturing of a goods, then it will be packaged, then it will be labeled, then it will be marketed, then it will be sold. So during that particular cycle, your production cycle will be long. You have a longer time span when you convert your raw material to a product. So in this case, you have to have less and less working capital requirement. During the peak season, it will be higher, but during the lean period, it will not be required. So your working requirement will be less once once you are having a longer time span. During the shorter time span, you have to have more capital requirement. So it is a vice versa. Longer time span need less working capital required. Short time span require more working capital requirement. So in this way, you can remember the particular point. Next, credit allowed. Liberal customer credit lines expand the outstanding debtors balances. So this is a very fundamental point, or which is very much required. You should remember, if your credit allowed period is higher, then definitely you need more money or more working capital in your business, because this is how we are talking about this. That's why we are talking about the why liberal credit policy affect your working capital. If you are giving a more time for your debtors to pay for the sales amount, or you have provide the goods to them on a credit basis, then they will pay after 2 months or 3 months. So definitely during this requirement, during this period, you have to maintain an additional amount of working capital in your business. So liberal customer credit lines or credit policies need you to expand, need you to increase your more working capital requirement. So it also expand outstanding debtor balances, because the debtor is not going to pay you as early as possible, because you have given them a certain amount of time, say a 2 month to 3 month, to repay their debt, repay their amount of the sales or credit sales. So in this period time, you have allowed them goods on credit. So you need to maintain extra working capital in your business. If you are failing, if you are following a particular liberal credit policy for your business. So this is very fundamental point, fundamental factor that you need to remember. Next, credit avail. As you allow credit to your customer, in the same way, your creditor will give you credit time. So, if you are availing a credit time period from your creditor, or you are procuring inputs on a credit terms, minimizing the direct cash requirements. If your creditor will allow you for a period of 2 to 3 months, then you need to pay back for the raw material you have purchased from them. Then definitely you do not need to have a more working capital requirement, because you do not have to pay them instantly. You do not have to give them the price they want to charge from you. You do not have to pay them for the goods they have supplied to you. So if credit allowance is higher, then you need to maintain higher working capital. If your credit avail is higher, then you don't have to maintain higher working capital, because in this case you do not have to pay more amount to your creditor. You do not have to pay your BP instantly. So 2 to 3 months is a sufficient time. During this time, less working capital required. During this time, less money you need to save in your business. So this is how your liberal credit policies will affect your working capital requirement. Next, operating efficiencies that you want to understand. Operating efficiencies, faster inventory and adapter turnover drop operational fund pressures. If your business is financial if your business is operating with a more efficiently, if you are facilitate a smooth day-to-day operation, if you streamline your efficiently your business activities, so you definitely need less and less working capital, because your inventory will be consumed fastly in the market. Your inventory will consume fastly in the market. Your debtor will pay you as early as possible. Then definitely your operational fund pressure reduce or lower. So once you are following the operational efficiencies or operating efficiency, you do not have to worry about your inventory. You do not have worry about your debtor, because in both the cases you are able to manage your inventory, because it will be consumed by the market, or it will be supplied in the market. What you have produced in terms of in terms of shoes through the leather, so it will be consumed in the market. Your debtors will pay you on a time, though, so you do not have to worry about your working capital. You can pay them instantly. They will pay you instantly. You do not have to worry. Your cash account or say bank account will be sufficiently fulfilled or filled with the money. So do not have to worry about your working capital. Next, availability or accessibility of raw material. Interrupted supply or a lengthy lead times demand or necessitate or call for larger stockpiles. One of the important questions that I'm going to ask: when do you need more raw material, or when do you access more raw material once you need to produce your shoes or something important? Your raw material is only required when you need to make an uninterrupted supply, right? But if you have interrupted supply, or if you have a lengthy lead time, or in terms of raw material that will come to your factory, you have to manage them continuously. So in this case, you have to have more raw material in your stock. You need to maintain a extra raw material in your business. For that, your manufacturing of shoes should not be hampered at all. So in this case, you need to maintain a high working capital because you are continuously producing, you are continuously investing in your day-to-day operation. You are buying a raw material. If you know that if you know that your supplier is slow and he or she would not be able to supply raw material on time, then you already demand more. You already demand more raw material from them. Please send me this amount of kg to me. So once you start buying that amount of money, that amount of raw material, you have to pay them instant amount for the purchase you have made in terms of raw material. So that's why you need extra money or extra working capital requirement for your business, right? So you have to be very careful about the same. Next, growth prospect. Large production targets increase or escalate immediate current assets requirement. If you want to grow your business, if you want to make your business expandable or more, if you want to expand your business in other cities as well, if you want to expand your business in other country as well, definitely you need to have a very l- requirement of current assets in terms of your raw material, in terms of your debtor, in terms of your creditor, in terms of your bills requirement, in terms of your BP. So here you have to require your current assets in a more than your current liabilities. So larger production target increase or escalate the immediate current assets requirement. If you are prospecting about more growth in a shoe manufacturing, if you want to set up a new factory up your that is situated or that is nearby your already established factory, so you need to maintain extra working capital requirement for your growth perspective, right? Extra money will definitely require for your growth. Extra money will definitely you need to maintain for your extra manufacturing aspects. So in this case, gross prospects will definitely allow you to maintain extra working capital requirement into your business. Next, level of the competition or say degree or extent of the competition will also impact your working capital requirement. Competitive market demands higher or greater finished stockpiles or soft credit. If you want to have a more competition, or if you are following a great degree of competition in your surrounding, in your nearby market, definitely you will have to maintain your finished stock of the goods. You have to s- give a very liberal credit policies to your debtors so that they can give you back the amount you own them with the given period of credit amount of time. For example, if you want to if you are facing a extent of competition, your competitive markets demand higher or greater finished stockpiles and soft credit. If you want to maintain a regular revenue from the your local market, and there is a stiff competition between the different shoe manufacturer, they are supplying their shoes in the market, but there is a stiff competition, then you have to pay them a soft credit policy to your debtors to whom you want to sell the shoes, you whom you want to sell them a huge quantity of the finished goods that you have manufactured, but they will give you the money after 2 to 3 months once they are able to sell the finished goods that you have given them after manufacturing. So once you are facing a stiff competitions in terms of finished goods or the in terms of finished product, then you have to provide them a soft credit or more stock inventories in terms of maintaining your business for a long period of time. So in this case, you need also working capital requirement, right? So you can maintain your business by relaxing on the market condition, or if you are facing a stiff competition in the market, then you have to pay soft or mild credit policies to your debtors, or you sometimes stock more and more shoes or more and more finished goods at their showrooms or shops, so that they can sell the goods and they can refund your revenue or refund your sales amount on a given time. But till that time, it might be a 2 month, 3 month, but at that moment of time, you need a working capital. So level and degree and extent of competition definitely affect your business, your working capital requirement. And last, inflation. We are on a last point. Rising commodity prices increase the funding needed to sustain production volume. This is a very much important. This is very fundamental. It is a very crucial point that we are going to discuss. If your business in a working in such an economic condition in which the price is continuously increasing, rising the commodity price, rising the prices of shoes, rising the prices of commodities that you are manufacturing, so definitely it is hard to sell the market instantly. You have to supply the goods in the market in the on a rising prices, but it will take time to return your money. It will take time to give your sales revenue to you. So in this case, once you have to face the inflation, in the case once you have to face the rising prices, you definitely have to maintain extra working capital in your business, because you have to continue your business, you have to continue your manufacturing unit, you have to continue the supply of the finished goods to the market at the rising prices. But definitely it will take time to come returns to you. Definitely it will time to return your money to your business. So inflation definitely allow the companies or the businesses to have a more working capital, or to maintain the more working capital requirements into their businesses. So this is how you understand your working capital requirement. So now you have understood that what is a contrasting situation between the fixed capital requirement and the working capital requirement. But how would you relate this? How would you relate this? When do you need a fixed capital requirement more? When do you need more working capital requirement? So the factors that we have just understood, that we have just studied, will help you to generate more fundamental knowledge when you need a fixed capital requirement and when you need more working capital requirement in your same business. So this is the fundamental point that you understand through the particular point. So in sum up, your fixed capital refers to the long-term asset that you purchase for producing or manufacturing the goods. It is affected by the several factors. Working capital requirement is based on your short-term business requirement to maintain your day-to-day business activities, to streamline your business or day-to-day business activities, or to facilitate the seamless production of the goods and services. So in this case, you are calling your working capital requirement for a short-term basis. So once you are purchasing your machinery, it is a fixed asset, it is a long-term asset decision. If you are buying your raw material, paying your salaries, paying your raw materials, paying your electricity bills, this is your working capital requirement, and focus on short-term decision making or short-term business requirements. So there is a subtle difference between the two. So after discussing this fixed and working capital requirement, hope you have understood the major difference between a fixed and working requirement. But at last, the question I ask you, if you have a 1 crore rupees in your business, or you have started a shoe company or shoe manufacturing unit with a 1 crore rupees business, so Would you spend all the money in buying a machinery, or you would keep aside a certain amount of money for your day-to-day operation? So you have to maintain both kind of capital, fixed capital and your working capital, right? So this is the answer to the question that we have understood through this particular point or discussion, right? Thank you very much for your listening. And if you like or if you found this video helpful, then you can like, share, and subscribe. See you in the next video. Till then, take care and have a nice day.